A very good afternoon, everyone.
Hello.
I was just thinking through my own journey of last 30 odd years, being in the professional world. Three decades back, we were possibly doing a session on what is mutual fund. And we were trying to, educate our partners, our friends, clients. And that journey had transited into today. We're talking about alternate assets. But that's the kind of journey we all have traveled. When we talk about alternate assets, I remember when we used to, actually we had moved a little beyond of talking on mutual fund, we started talking on alternate. And those were the days when alternate used to be PMS. That's the far thing that we could think of. And we could used to say 10% in a PMS, at least you have taken a little bit of a diversification, but still staying within the listed equity space. And today, we have gone beyond listed, we have gone beyond private equity, we have gone beyond performing credit, beyond real estate. We're talking about warehousing as well. Now, this is the journey that we all, being partners in one way or the other, have traveled. And today, the panel, if you would see, have a representation across the, so to say, alternate asset class. But you would have seen I'm carrying a piece of paper with me. It's purely because, actually, I also wanted to make you all get some reality check. Because alternate still, I don't know if we have really understood what alternate is all about, if we have understood what potential it can really offer. And most importantly, is it a choice anymore? Or is it something which needs to be now embedded in client's portfolio? And how should we be doing it? Obviously, I'll leave it up to you all. So let me give some numbers. Globally, the AUM, if I look at, is close to $120 trillion. Now, this AUM in 2005 was $37 trillion. 21, it was 108. And if you would refer to the BCG report, by 2026, this AUM is slated to be $149 trillion. These are the global numbers. Now let's look a little bit of a deep dive into it. The percentage of alternate share in 2005 was 11%. In 2021 is 18%. And 2026, this share is slated to be 19%. 19% on a larger base of $149 trillion. Let's come to our own self. At the end of the global is more of an indicator. The real world is what India is all about. In India, India's share of alternate is 12%, while we see this growing to almost 17% as we look at by 2026. If you see the growth, the mutual fund in last 10 years have given a CAGR of 17%. PMS has given a CAGR of 13.5%. And for you all to know, the CAGR of alternate is whopping 52%. Obviously, you and me can debate the base is small, and hence the CAGRs are looking bigger. But the reality is, the CAGRs are looking bigger. The private credit, what used to be 2% of the alternate space in 2005, is 17% by 2022. And if you look at our own share in APAC, which is on the PEVC, the number of 15% what it used to be in 2018 has grown to 20 in 2023. And the one who are losing the market share in the APAC actually is China. So that's the way we are moving in. And concluding our data, if you look at 50 lakh crore being the listed and all of that assets in 2021, our own view is that number should double by 2026. And if I look at the constituents of the doubling, alternates from a 12 to 19 is likely to demonstrate a CAGR growth of 24% against active, which is today at 67, likely to be 58 in the journey by 2026, is looking at growing at 10%. So that's the larger picture, which I wanted to leave it for you all as a food of thought, just to understand that these real numbers are real and the opportunity is huge. Now to build on it, Amit, let's start with you. Now you have been managing close to $4.5 billion of assets across the strategies. Now, if we talk about a private credit as a space, what you feel is the landscape, how is it growing? And most importantly, how do you see an investor getting benefited by being an investor into one of the funds in the private credit space? Your thoughts on that?
No, thank you. I think one of the vectors that I see for private credit growth is that I have been on more panels in last 1 year than last 15 years in Edelweiss alternatives. So EAAA manages $4.5 billion of credit, and it has been managing this for now 15 years. We were like the starting guys in this market, when the market used to do maybe at best 3,000 crore of deals in private credit. In fact, at that point in time, it was called lending money. So today also it's nothing but sort of lending money in a very different patient capital format, which provides bespoke solutions. So despite all the jargon, if I was to shift just the basic premise, it is about flexible financing solutions to corporates who are in need of those solutions, and having the patient capital to help them grow as India charts its journey. Because India will grow, and it can't be only fueled by equity. For every rupee of equity, you need 2 rupees of debt at least. So to give you very broad India numbers, the total stock of credit is around 160 lakh crore, of which broadly bond market will be around 30-35 lakh crore, but private credit will only be 1.5 lakh crore. So it's not a very big space. It is a small portion of the credit. The annual credit delivery into the system is around 30-35 lakh crore. And the private credit invests around 70-80,000 crore. So it's a small segment because you have to find those transactions, you have to build those deals. And primarily people borrow these money for growth needs. So the spectrum of private credit can range from performing credit to special situation credit. It could have real estate credit, it could have core credit. So the landscape is all credit, and the situations in which you are investing could be varied. Now the return spectrum from a private credit perspective depends on the transaction, on what you are doing with these deals. So you could have a return spectrum all the way from 12% off to 20%. So depending on what is your risk appetite as an investor, you can choose a fund which provides these solutions to you. So effectively what you are doing is an asset allocation, which is a very global phenomena. I'll tell you a very interesting thing. We raised money globally as well. So 60% of money comes from our global investors, and 40% money is broadly domestic money today. The global investors are always about diversification and asset allocation. They are not of those kind who will put all their money into only equity or only debt or only a specific strategy. These are very large funds, pension funds of $50 to $500 billion in size, and they will do their asset allocation. So India is also a diversification for them, and private credit is also a diversification from them. Come to India, the role of asset allocation is with the family offices and the high net worth individuals. Because here the pension funds are allocating capital basis the regulatory requirements. How much can they actually invest in equities? How much can they invest in other asset classes? So for them, diversification is both in terms of returns, but also in terms of how the regulatory regime speaks. But the family offices have definitely understood the importances of diversifying into various asset classes. So that is how the private credit market has improved. And in India, 5 years back, we almost had only 10% of AUM from a domestic capital. And now today it stands at 40%. So I think it has grown over a period of time. And as the Indian market matures, this will be even better. But effectively, when you talk of private credit, A performing credit strategy will lend to a corporate who needs the money for maybe stake enhancement, growth requirements, or it could be solving some capex requirements or any other thing. While a special situation fund would go and do some turnaround investing, it could invest in opportunistic credit where maybe a bank wants to sell its portfolio or a NBFC wants to sell its portfolio. But as we say at EAAA, the key is to have capability before capital. As a firm, you should have a capability to manage those investments. As a firm, you should have a capability to assess those investments. And most of the investors are looking for track record of the managers because they don't really understand how the market really works. It's also about the trust and what track record, what capability the manager has. So those are the key broad dynamics of private credit in the Indian market.
So let me build with you, Shekhar, where Amit had left. So Amit had given a very nice perspective about the landscape of the private credit, both globally and India. But in your own experience, when you are managing the people's money, we do appreciate that risk parameters, the risk buckets define the yields and so on and so forth. And as Amit said, can start from 7, 8, it can go up to 20, 21, depending upon what kind of risk are you ready to onboard. Where do you see clients' interest, which is fitting into the overall scheme of things? Which yield bucket you see the interest being higher, and how are you responding to those interests? So just a little bit of overview, more coming to the client's perspective.
Thank you, Ninya. I think I'll just bring the equity analogy in this conversation. Like we had all the mid-cap, small-cap, large-cap discussion. And if you play the same thing on credit, actually, unfortunately, when we say credit, it's all painted in one brush. We need to just segregate depending on the strategy. So there can be a large cap or a mid cap and a small cap. And general connotation in equity is that small cap will give highest return, mid cap will give a better return, and a large cap will be a kind of a consistent compounder kind of thing. And definitely a large cap can be an underperformer as we have seen. But in credit, if you play the same style as Amit laid out, like there is a performing credit, there's a special situation or a high yield credit, I think it is up to the investor how he wants to do a debt allocation of his portfolio. And assuming an investor has $100 to allocate to his portfolio and he will put something very safe in a mutual fund or a bank deposit, and the rest he can allocate in the different strategies in private credit. And be it a performing credit or be it a real estate or be it a very high yield credit, each of the bucket will have a very different risk reward actually. It necessarily doesn't mean that a performing credit can also go wrong or a high yield credit can do very well actually. But going in thesis in all asset classes in these buckets will eventually mean a performing credit should deal with a good set of companies where you are solving the need which banks cannot solve for them or a mutual fund cannot solve for them. A high yield would be slightly much higher return where effectively it is a special situation where banks don't want to come for X, Y, Z reasons, and then you have an opportunity out there. So the investor have to figure in their mind what kind of risk reward they want to take. If somebody wants to, like in equity, want to play all small cap, it's best he plays the high yield special situation fund because that would probably give the most highest return to him actually. But if he wants kind of a steady state, kind of a regular return phenomena, he may be better off doing a performing credit. So the investor has to choose what risk he would like to take, and between the buckets he should pick and choose. Don't paint everything as private credit together, and just like being a warehouse what Yash manages, which is a very kind of an annuity kind of a product. If you want a very steady state return, that can be a different set of product actually. So you need to pick and choose what risk you are comfortable with, how much portfolio you want to allocate in different risks, and more importantly, how you want to sleep. If you want like to trade in F&O and everything or something like that, you have to take a very different risk actually. And same in credit, you have to take a very different risk. The outcome can be both ways actually. So it's up to an investor how he wants to do an asset allocation within debt in different strategies.
No, I agree, completely agree with you. At the end of the day, it is the investor's own choice. Let's move beyond private credit, I think, performing credits and all of that, and let's move to the real asset with you, Piyush. You come from a city called Ahmedabad, a buzzing city.
Yes.
We have more than enough reasons to talk on Ahmedabad. One reason I really want you to comment on, what is it so special about Ahmedabad on the real estate? Because we have been hearing a lot of buzz. We seriously want to know what is it that is creating Ahmedabad so much in buzz?
Sure. Thank you. So Ahmedabad basically already it's a rapidly growing market. Okay, there are various factors which influence Ahmedabad as a market as for real estate investments. Robust infrastructure development which has happened, investor-friendly government policies which has come in, and the economic growth which is supported by diverse industries which are there at this point of time. See, in Gujarat, people talk about GIFT City. GIFT City is meticulously planned infrastructure. And in that, currently, more than 400 companies are hosted, and more than 25,000 employees, professional employees, are employed. Earlier, to reach a GIFT City, about few years back, it used to take 1.5 hours from Ahmedabad 𝐻𝐭 area to reaching to the GIFT City. Today, it takes hardly 30 minutes to reach in GIFT City. And that's kind of infrastructure has been done. So many flyovers which has built supports the infrastructure and connectivity which is there for the real estate. And that's what it makes a different from other cities which are there currently in India. In Ahmedabad, if you look at one location to reach to another location, it has multiple approaches which is there. Ahmedabad has been planned in such a way that it's circular, so that reaching it becomes very convenient and has many access. If you have also heard about riverfront which is there, Sabarmati riverfront which is there, the government is planning to do a development right options for bringing more developers to develop riverfront as a beautiful project. Their social infrastructure, public infrastructure, that's what helps to bring more real estate development. And all these companies which are there, they want to also reduce their cost. As global center companies which are there, they are coming towards tier 1 cities like Ahmedabad, where they can reduce their OPEX, CAPEX, and have the same quality of infrastructure which they are available in the major top cities which are there. In Ahmedabad, the riverfront development is bringing a tremendous growth opportunity for investors to come in and develop the real estate projects. This is the overall journey which looks like. I am in Ahmedabad for born and brought up in Ahmedabad. I have seen the development growth which has happened in the last 10 years. Hardly 3 players in Ahmedabad used to do a full check transaction, and that's what the market was. Today, if you look at more than 10 plus developers delivering quality commercial residential projects which are there. That's what the attraction for the investors. The transparency which is showcased now, helping investors to take a bet on Ahmedabad as a market.
Well, I think quite interesting, and I'm pretty sure besides the opportunity, it is also the regulators who are ensuring that everything should be in paycheck only now, and no more cash, because that's something which is not about Ahmedabad alone. I think you go to any city now, developers are just not ready. Well, you know, as a 361, I always used to say that one thing we used to take a pride, which is innovation and ideation. Like, we have been first in many things, like, pre-IPO markets. Now, recently we have launched a secondaries fund. But we completely got stumped with someone like Yash when he came up with a very different idea on a warehousing. And he created an AIF structure on a warehousing, did pretty well. Yash, what made you think? Well, what was it, something that few things that you could cite in the warehousing that you created a fund, did very well? So why don't you enlighten the audience on that?
Absolutely. So first of all, just to put real estate into context, right? I think when you look at real estate as an asset class, for most institutional investors globally, it will probably form anywhere between 10 to 20% of their overall asset allocation, right? So real estate by itself, even for large, sophisticated institutional investors, does form a very large allocation. If you kind of think about real estate in the Indian context, right, I would imagine that given that real estate is a very there is a cultural affinity for real estate, I think, which Indians have. So for most investors, real estate, whether it is in most cases direct real estate, would also form a similarly large component of value, right? So overall, it is a very important investment class. I think the great thing now is that for most investors, there are options opening up where you're able to avoid all of the hassles of investing into real estate directly and avoid owning physical real estate, and instead get exposure to the asset class through a structure like a AIF, etc., which is what we've tried to do for one specific vertical inside real estate, which is warehousing, right? Now, when you look at warehousing, I think it's a very interesting asset class When we kind of thought about this, about 5 years ago, warehousing was already becoming something which was very much in focus for large institutional investors globally, and largely driven by the fact that there was a lot of growth in e-commerce. And of course, we have seen that in India as well over the last 5 or 6 years very, very aggressively, especially through COVID. And this e-commerce growth was really driving growth in grade A warehouses, right? And I always kind of draw parallels between this story and what we have seen in commercial office, right? And commercial office as a sector is something which a lot of us are now obviously very familiar with. We have seen the sector develop over the last 20 or so years, starting from 2005 to now, where we have seen about 700 or 800 million square feet of grade A commercial real estate being built and traded. And if you kind of think back to 2005 and really see what started that boom, it was very simple, right? That on the one hand, you had very little good quality supply of grade A commercial real estate which was available. At the same time, you had a lot of these large IT companies, MNCs, etc., coming and setting up shop in India, and they demanded good quality real estate. And that kind of set off the boom, which we have now seen over the last 20 years, where, there was a building phase where developers backed by private equity money created large format commercial office and IT parks. There was a consolidation phase where we kind of saw large funds coming and aggregating inventory and creating large portfolios. And then there was a monetization phase where a lot of these funds kind of flipped their portfolios into REITs. And we now obviously have 3 listed office REITs. We have a retail REIT. In fact, we have 2 warehousing REITs as well now, right? So that's been the full cycle of monetization which we've seen for commercial office. Warehousing today presents a very similar opportunity where you're kind of able to play that same story again and get in at the ground floor of growth, right? And the reason is simple, that again, from a supply perspective, fairly limited grade A warehousing supply which is available. And at the same time, given what we're seeing in e-commerce, given what we're seeing just in overall consumption growth, given what we are seeing over the last couple of years on the manufacturing side, right? And more recently, we are seeing demand not just for your, typical warehousing which sits outside of the city. We are seeing demand for in-city distribution warehouses because of, the kind of demand coming out of quick commerce, right? So all of these factors put together means that from a demand-supply perspective, warehousing is a very interesting space to be in. At the same time, when you kind of look at the sector from a risk perspective, it looks very, very de-risked. For the simple reason that warehouses aren't really as complicated to build as a typical multi-story real estate project. Warehouses, for those of you who have seen one, are basically a tin shed, to put it nicely, which really doesn't take a lot of time or effort to build, right? So you're able to knock out one of these buildings within a matter of months and not years. And what that means is that because of the lower development cycle, because of the lower build complexity, the largest risk from a development perspective, which is really cost and time, is fairly mitigated by default when you look at warehousing, right? The other large risk in real estate is sales. So you typically end up investing capital to buy the land, you then end up investing capital to build the building, and you're only able to start selling, especially for commercial office, once a fair bit of the building is already out of the ground. Warehousing, again, because the development cycles are short, I'm able to present a pre-leasing proposition to my client, right? Which effectively means that once I've bought the land, I don't start building the building till I have a back-to-back lease commitment, right? So this also means that the other large risk from a real estate perspective, which is sales or leasing risk, is also taken out of the equation very, very early, right? And then finally, so you have a great, market, great demand supply, de-risked product. And from a returns perspective, what we find is that we're able to price these projects at a gross pre-fees and tax return of, let's say circa 20%, right? Now, these 3 factors put together made warehousing very, very attractive, not just globally, but also in India. And we saw, when we started this product, Anunya, that there was already about $4 or $5 billion of institutional capital chasing these assets. But at the same time, there was really no option which was available to domestic Indian investors to participate in this, right? And we saw that as a clear gap in the market, and we kind of came in with this product to try and sort of leverage that gap.
No, I think undoubtedly a great opportunity to tap and a great asset class for all investors to consider. But when we talk about all these asset classes, ideas, opportunities, one thing that comes in our mind is the risk framework. So Amit, a comment from you, when we look at creating the framework, what are the few things that you do keep in mind, keeping the larger interest of the investors on check? Because it sounds pretty good, but at the end of the day, what boils down to is how strong are the risk frameworks? Your comments on that.
So I think, we run in Shekhar's world a small cap fund, which is we raised 11,000 crores on our special sits fund, and we have a framework for special sits, and we have a framework for performing credit. The fundamental risk framework which is there is around 3 big vectors in our mind. One is counterparty. In credit, the counterparty is extremely important. How you diligence the counterparty, how do you work with that counterparty. Second is the cash flows, that what sort of cash flows can you generate. At least we have seen our investors love cash flows. As to the assets which are giving regular cash flows on the credit side, the probability of they defaulting significantly is lower rather than completely back-ended solutions where you give money today and receive only at the end of 5 years. So cash flows are the second bit. And third is the collateral. Now on collateral, it's important to assess the collateral. It could be the enterprise value of a company. But I think the ability to access the collateral in India has improved significantly with the bankruptcy court, which is where you see people not also borrowing indiscriminately like in the past, and they know their limits that they have to borrow, and they are also willing to honor their contract because otherwise they can lose their businesses. So there has been a massive credit culture shift, which is helping the credit funds. So this framework applies both across special situations and performing credit. However, the key difference between the two segments as we see is that the performing credit funds have to work on a very low probability of default. So they access companies where the we call PD is very low, that the company going to default, the probability should be low, and therefore they focus on that. While on the special situation side, our framework is to figure out what is the loss given default. That even if the company in 1 or 2 cases or 3 cases enters into a situation where it is not able to pay, you should be able to recover a lot of your money back. And I think in this whole framework, the most important thing is again the asset management skill sets and the capability. Where things actually go wrong is you lend the money and forget, which is where you don't do active monitoring, you don't meet the client, you're not looking at early warning signals. Like we have a 60-member team which is only on the operating side, operating and asset management side, which is across our portfolio. So it is very, very important to constantly observe what's happening in the asset that you have lent in. And believe me, the funds don't invest in too many assets. Like if you are in a bank, maybe as a dealing officer, you will have 50 assets or 100 assets that you would be looking at. But in a fund, let's say our fund, special situation fund, we are 20 people and we manage 60 assets. So it's 3 assets per person. So your ability to actually monitor those assets is very well. So I think the biggest risk mitigation is constantly being on top of the asset, assessing the warning signals, and ensuring that you are the first one to understand if things are going sideways. So that's, I think, broadly the risk framework in our minds.
Great. I think we are getting short on time. But Amit, quickly, with the current gap that we are noticing with the banks withdrawing, from the credit space broadly, how do you, as a true ICICI, you are able to capitalize on those opportunities? Obviously, keeping all the framework that Amit mentioned in mind. So quickly, if you can give an answer on that.
I think that leaves a big opportunity in India. Everybody is now moving away from wholesale credit and every bank is focusing on retail credit. That gives a big opportunity. But the other big opportunity in India, which is there, is like what banks cannot do. I think most of the people know that banks do lend, but when you take money from bank, you can only use it for working capital and capital expenditure. So if you need to invest or acquire a company or do a downstream investment, you cannot do it. So forget about what banks are leaving. What banks are not doing itself is a big opportunity for funds like me or Amit to help the Indian corporates to maybe streamline their whole corporate structure, get an exit to a private equity investor, so on and so forth. And coming to your specific point, banks are vacating. I think US, it is playing out. US people now thinking the private credit market is as big as the bank market. The biggest bank like Citibank has tied up with the largest asset manager called Apollo to set up a kind of a private credit framework to finance OPCO loans for working capital and normal businesses, because banks are not willing to do that. In India, since we have a limited access to capital from pension funds and insurance companies, there's some time to play, but over a period, the entire private credit, what we are discussing today, will not be at 12 to 24. It can become from 8 to 24 actually over a period of time, because there would be players and pool of capital which can just do what banks are doing actually.
Great. Coming back to you, Piyush, you did speak a lot on Ahmedabad as a market.
Yes.
Now, as a fund, how are you working on capitalizing on these opportunities?
So as you know, the Shivalik developer is a developer who has backed this fund. This is Gujarat's first real estate developer who has come up with the fund, category 2 register. As we look at it as a fund strategy and philosophy is to look at the growth areas, growth pockets which are there, and look for a mid-sized developer who is willing to develop that project and need a capital which is generally required at the land stage or an approval or TDR stage, as the banks are not funding this kind of a projects at the early stage. And that's what, as an alternate assets, we come in and fill that gap which is there. And when we invest, we also have a Shivalik as a developer, as a brand. We support that in terms of marketing, planning, design strategies, which is an independent services provided by the developer to that mid-sized developer. This overall tripartite partnership model helps to overcome overall project execution risk, the sales and marketing strategies which are there, and control over the cash flows which are there in terms of exiting the project. So this frameworks helps to generate, as a fund level, we are targeting to generate around 20 to 22% kind of an IRR, because that's what we will be able to achieve if we have this strategy, risk framework, and mitigate that in every stage of the cycle. Then achieving 20-22% kind of an IRR in a real estate space will be is a good return for an investors.
Great. And a quick comment from you, Yash. Again, the opportunity that we spoke on a warehousing, how Welspun is capitalizing on that. So what are the strategies that you're using in terms of getting it to the investors?
Yeah, so, very simply, I mean, we have now launched 2 category 2 AIF funds, right? The first one, which we did in 2021, the second one, which we closed earlier this year. Between the two, we've raised about 2,700 crores of capital commitments. And the business model is simple, right? We use the money which we have raised to buy land, to build and lease warehouses, and once the warehouse is fully built, fully leased, and I've basically created a rent-generating asset, I'm then able to flip or sell that asset to another buyer, which is typically could be a private equity fund, it could be a pension or sovereign type of investor, it could be an InvIT type of a structure, where typically we are able to get that bump up in value because of the value addition which has happened from the raw land stage through the development, leasing, and exit, through which we are basically generating returns for our investors.
Great. Thanks to all 4 of you in terms of helping audience understand, do a little bit of deep dive into opportunities. We have just run out of time now. Thank you all for giving a patient listening to all of us. I hope we did manage to add some value to you all through this panel. Thank you.